Awesome. Very good. All right. Massive Realty Group. We're doing a little bit of rebranding here. Some more is going to be coming on that. One of the things we're going to talk about, inflation is like cancer. It's hard to remove once it's inside the body. How can you plan on maximizing this opportunity? So we're in a series webinar, The Art of Deal Hunting. So very, very topic right now. So on the right, of course, we have John D. Rockefeller, who made a very, very statement. But the way to make money is to buy when there's blood running in the streets. I've also seen the same quote with Carnegie where he adds, even if it's your own blood. So quite interesting that, and if you think about it, right, there was a crash. There's definitely people that were affected in some of them, but more millionaires were made that seized the opportunities coming out of a recession, coming out of different challenging economic times. All right, disclaimer. We think we're smart. We're not always sure we're smart. How's that? I always wanted to say that. It's funny. So somebody said they didn't know I was funny last week, I guess. And I thought, okay. So we are not lawyers. We're not accountants. We're not professional financial analysis. But what we do is we study everything. We have a full team that looks through all of the data, all of the details, because it's super important to make data-driven decisions. So this is our team. On the left, you have the principals, Sanjay, Shirar, and Mike. And then on the top, there's myself, Jasmine, Maria, Candice, and Aswad. And then in the middle, we have our acquisitions team. So Brad, Ramesh, Vankar, Jen Brown is our asset manager. Bindi is our accountant. Then across the bottom, we have Angela, Senate, Jonathan's our legal counsel, Senate Education, and Carrie Special and Events. And we actually have one we're going to announce tonight. We're super excited. We've been working hard on this event. It's going to be fabulous. So this is a little bit sort of an overview of all of the verticals that we like to engage in, we like to understand. So the very first one on the left is land banking. And that's basically where you would buy land and hold it, hope that it was appreciate. Land packaging is when you buy the land and then you start to get it ready for building. So we have one of those projects right now, 10 acres in Georgetown. And then we'll do a land development after we get it all entitled. And then there's building development. So it's when you go vertical, building operations. So it's when you're buying different businesses that are in existing. Building renovation. So a lot of that is either repairs or maintenance or value add. And then there's property redevelopment. It's a little bit different than value add, but it's somewhat similar. And so on the partnerships here, we have been partnered with Realty One Partners and Massive Capital. Super important that you have the right partners in each vertical. And on our multifamily one, you'll see next on our list where all the different places where we are. So on the bottom left are all of the assets that we closed last year. And then on the top is under contract. Many of those we have strategic partners that have local excellence, local market knowledge. They have boots on the ground. They know what they're doing. So it's super important for us to be able to elevate ourselves and get to the next level, partnering with people. We're always looking for ways for synergy and to be able to do more. We have all of the projects on the top. So we have a wait list on our X-Space Houston. We're super excited. That one's very well. Then we have a retail one in Houston. And then we have one coming up in Denver. And actually, we're 80% subscribed as of today. So that one's closing soon. And we will do a little shameless plug. But that one is a great deal. The Denver market is really an interesting market. So, all right. That's the Denver one. Look at there. So we have to have a shameless plug. So as I said, we are 80% subscribed on this particular unit. Our goal is to close on the 27th. So if this is something that you're interested in investing, anyone that's on the Massive Capital team can help you. You can also scan that, go to our portal, register, and you can look at all the documents. It's not something that you need to actually sign up and send your money in, right? You get a chance to take a look at the deal. And then until your money is in the bank and your documents are signed, But this is an awesome property. It's a really good, it's our second one in that market, again, with a very strong strategic partner. All right, and then away we go on our case study.
Sounds good,
Put your
Trevor.
seatbelts on, folks. Put your seatbelts on. This is always a wild ride.
Okay, it's a fun ride too, right? So as I get into what I'll do is that I'm gonna try to give you an example of how do we define and what a good deal looks like based on what market we're in, what time, what's the cycle, and also we'll share a little bit more what the massive believes and where we at and how we are taking a look into it, right? So almost think about we're gonna go play against a very strong team, and so before we get in, we're gonna study what the team is, what the climate is, what the field look like, and what happened historically in that area, right? That study, understanding the game, understanding the mindset of the opponent, it's almost half of the game, right? It's half of the winning. So that's the perspective I will take in terms of how we define a deal, and then we kind of go from there, right? So first slide, before we get in, it's the market cycle. As you may have seen this one before somewhere else. This is the emotional roller coaster and the financial roller coaster that we kind of go through. Typically, from the top of the cycle last year before last to the bottom of the cycle, it takes about 1, 2, 3 years or so. But we experience a very steep cycle on this one. So that's the timeline. 2021, 2022, money came in, free money, government funding, then our profit from the equity market, everything kind of bottlenecked here, and funding was available, and we bought assets. And here we are at the bottom of the barrel, 2023, and we believe we can stay here in 2024 because inflation has always been a sticky. So if you look at it statistically, all the inflationary time that we had, it never went up quick. So one thing we understand from the Fed perspective, we're not going to repeat what we did in the early 80s, which is rate up, rate down, rate up, rate down. We're going to go up and hold it there till it goes down. So as you can see the job data, so there's one sector the Feds are after, which is not quite there yet, which is the service sector. Real estate 50%, that came down. Then the service sector about 30-35%, that is not coming down. And that is directly tied up to the job sector. So Feds are going to hold the interest rate higher for longer. That's why we're going to see a pretty steep curve, steep U there. So that's that. Now for us, when we take a look at it, we believe every cycle is a buying cycle. It's just not the way we buy, right? The way we bought the up cycle, that's not the way we buy in down cycle, and vice versa. At the same time, the way we go about buying it, it's not something we should discover. We should have a play in mind. So when we go out there, we execute the business plan, we execute the strategy as we go. So on the right side, that's typically we buy. Then I'll combine them together. So on the left side is the cycle of the market. On the right side is that's the way we buy, right? We have the fixed debt, 65% leverage. Then we have some floating debts that you see. Then you have the bridge debt, and then you have the bridge, a non-recourse, no interest rate cover pref chips, right? So from the leverage perspective, this is the most way you can lever. And once we lever a property 75-80%, there's a financial term that we call it debt overhang. That means no matter what we do, I must earn a certain amount of money, otherwise I go bankrupt. And what happens if you do this one at the very top of the cycle, you made a mess. So 9 out of 10 times when the assets are going out bust right now, is because of that. So we levered up so high, not understanding we're on top of the cycle, or we're believing the market cycle will even go higher, and market turned, I could not produce the revenue I have to produce to pay the bills, and I'm done. Plus, I don't have any breathing room, right? And that's why we say when you look at the upcycle, you play against the conventional way, and you push yourself from here down to the federal and federal. So you try to give yourself enough breathing room. That was one of the main reasons the big boys or girls, they did not buy assets in the high cycle. We heard the terms while the big guys are putting the pencils down. That's why. Because everybody here bought on a pro forma. To buy on the pro forma, you have to lever it up. And when you lever it up in a top cycle, you created a chemistry where something goes sideways, kaboom. And that was the biggest thing that happened for a dominant side of the assets that fall out. Case in point, I talked about it maybe probably last week. 2 weeks ago, I walked a property, a little over 400 units in Houston. Good team, good business plan, good execution of the CapEx. bad strategy, bad timing, no rate cap. They're about to lose about $11 million. And they called another party by saying that, hey, could you buy the property at a loan value? So even though I lost my money, I didn't get a black eye and a black stamp because I have a foreclosure on my dot. Property still didn't make sense, right? So that's the play that we have, right? Now, there's a conventional way of playing it. Again, we understand that one top of the cycle, as you write, we should go down from the high level to low level. Now we're on the bottom of the cycle. How do we play? We just reverse it at that. One is the bottom of the cycle, we lever it up more because we are bottom of the cycle. How much can I go up? Go down, not a whole lot. That's because we're expecting rate go up another half a basis point, and that's it. So if you take the chart on the left and you flip it, the best time to buy is right here. So point is, when that whole comment came about, wealth is made when the blood is in the street, it is right. Someone is losing $14 million sad. On the flip side, whoever can buy that at a little bit more haircut at here, it can't go worse anymore. It is there, right? So philosophy is that you go backwards. When you're on the bottom of the cycle, you push yourself to as high as you can from there. So you ride the wave of the higher interest rate. So think about this. If we can buy an asset for a 10% interest rate today, I know it's double than what we think of. If we can buy a property at a 10% interest rate today and do absolutely nothing, we go to sleep, wake up in 5 years, and we sell the property when interest rate is 7%. We're in the money just because interest rate went down, right? On the flip side, it's not possible. That's why we believe that market cycle deal design is different, and that's how we should design the deal, right? So that comes into the play of our next one is that, okay, we understand how to understand the risk and the exposure, then we understand how to design a deal. Now the question is, if I'm an LP, if I'm a GP, what deals do I avoid, right? In very short way. So our strategy has been, we must have a differentiating factor for us to do a deal or win a deal, or everybody, right? If you're an LP, look at a deal team, they must have a hard skill set. What I meant to say, if I have a dental issue, I don't go to a regular family practice guy, right? I go to a dentist. I got to have a deep expertise, and then whatever that we buy, the debt should be as high as you can, close to the market, and then don't venture out. Stay put where you are. This is not the time to venture out. To hunker down, get into the market rates, stay close to the market, and build your play based on what you know. Avoid learning, right? We all want to learn, but the learning curve is very dangerous and expensive if you make mistakes, right? So if I put everything together, there are lots of ones, but it should be 1, 2, 3, 4, 5. We avoid, or we have a pause on very low interest rate. If we see a deal, 2.5% and 4% loan assumption, 4.5% loan assumption, we should get out from there. We shouldn't even do it because it's an upside down deal. Unless we have a very good, solid business plan behind it, right? But again, those are all in general with the asterisks on the side. Then the larger assets, if someone has a 400 plus units and there is a market rated product, they're gonna have a tough time. The reason being is that 150, 170 units, you can cycle that out very, very quick. 15, 20 units come about. And if you have 400 units, that's a city. That's like the whole neighborhood you're going to turn. It takes time, and it doesn't have enough time. But we can turn around 150 units in less than a year and a half. 400 takes 2-3 years. So when we have a 400 units, it takes a much longer time to turn around. It does not allow enough time to maneuver with the market change because sometimes market goes faster than what you can turn. This is a big ship to turn. Multifamily. So we avoid that has a heavy bias on pro forma for valuation. That means. And I'm buying based on the belief the market is going to go up, rent is going to go high, unless you have internal data, right? This is where we said don't venture out. If we're in Houston, play in Houston. You don't have to go to Corpus Christi or Louisiana or Dallas, somewhere else. Time to figure out the market because the local people or local partners already figured that out. They believe it's not a good one. How do you think it's a good one, right? Office, avoid office where GPT doesn't have a technical skill. Technical skill means they're in the office game. They have a brokerage. They have something in that fashion that makes them different, right? And when a syndicating team come together for the first time buys an office because price is cheap, don't do it, because what we're seeing on the office, there's two sides of the story. One side is cheap. It is cheap. I mean, Houston, we are 3-4 years out of the whole country. I mean, it is just dirt plus $10. You can buy an office. 1/4, 1/5 of the replacement cost. But if the team doesn't have any, skill to lease up, then what's the point, right? And also on land development, the whole GP team. If the GP team doesn't have a technical expertise in development, avoid. It's a very unknown. The land construction, conversion, those are deep expertise needed and skill set needed. Been there, done needed. It sounds good. I want to buy a land, and I want to go. We'll hire some of the guys and do the entitlement. Then I'm going to flip. It's very simple. But when you get to work, there's a lot more to it. So we pay attention when we take it like when we look into those. Then the second one, it's as we take a look at some of the other players who are winning deals, they're doing deals. My friends are closing. And there's a guy, one of my friends, he's going to buy this asset probably at a good haircut. And then we also have a couple of partners that are doing 7, 8 new construction deals. And plus we are doing deals also. We're underwriting, walking a lot of assets, talking to a lot of GPs. But in general, those three shows up everywhere. They have a very, very strong balance sheet. 3, 4, 5 times of the debt needed for that particular project. That has been our philosophy as well, from the massive perspective. And our philosophy from day one has been, we don't do a deal unless we have a 3x of the balance sheet. Unless the GP team has liquidity of 3 months of the working capital needed. Things go south. They just do, right? When that happens, if the GP team doesn't have that 100, 200, 300 grand to shell out, then you are in a position you have to call LPs all the time. Multifamily, it's a very good game, very, it has a huge upside, and also it needs a little bit of cushion to run it. So that's that. And we're also seeing that from all the banks that we're talking to, and they're asking, can you prove that? And we are seeing over and over time, non-recourse are getting less, recourse are coming into the play. Except the multifamily existing assets, agency debt, we're saying recourse word is showing up quite a bit. And 9 out of 10 times your GPs that we don't do full recourse because the balance sheet limitation. So that's that. We have 3 deals in the pipeline. 2 of them will be recourse. Massive does recourse only for our deals, but we're comfortable. But pay attention to from that angle and what the balance sheet looks like. Put a 3 in terms of that as you can look at it. Other one is the technical skill. What we're seeing, either they're vertically integrated or they have something that differentiates them from the market. They have something. They have some understanding or technical skill. You just can't find it, right? So that's that. In other words, what we're seeing is that it is easier for a construction company to become a syndicator versus a syndicator to be a construction company. It's like expertise is in there versus they have the expertise to come over here, right? Those are the 2. And the third one is the equity. Availability of equity, especially the large amount, are really making the play. Like I used the example last week in San Diego, they had downtown office building went up to market $275 million. It was traded like $60 million. Somebody came and paid it all out. That's the play. If you have it, buy it, hold it for 3 years, go to sleep, come back, it'll be in that. So that equity and that technical skill and balance sheets. Now, those are 3 different ones, but sometimes you have a little bit of advantage here, then a little bit of here, and somewhat here. When you stack them all up, it becomes a play. So, and that's how you go back and design the deal that you have. So that's how we take a look at it. And that's how we believe the market is, and we believe it's gonna be in that stage for another year to come. And then slowly we'll see which way it goes. Probably towards the better side of it. The last one is the massive strategy. So I'll start there. Market rate debt. We want to pay as high of interest rate as we can, and that puts us on a price reset. That means we are buying everything at today's price. we're not buying an asset with last year's price, which is why we like new construction, because the price has been reset based on the construction cost, the labor cost, and also the high interest rate that we have. Also technical skills. We'll stay where we have the expertise. That means going back to the Denver property, it's far away, but it's not far away, right? Because we already have an asset less than 10 minutes from there. So we have some additional data point, what others don't usually. When the deal came about, we picked it up. So we have two assets. Then we also have a triple net retail center. And if you look at it, we have data point from the multifamily, we have data point from the commercial. And in the middle, there's a new construction shown. Expensive product. What, Sanjay, correct me if I'm wrong, about $350 a square foot to do the construction. But guess what? We have internal data set and understanding to say, if we can build that at that price point, we are going to make money. So we are pushing for it, right? That's that. Same with the multifamily new construction, because of the asset price reset on the land. We have data point, we own assets across Dallas, Austin, and Houston. So from that perspective, we're doing new development. On the new development topic, it is a bolt-on acquisition. That means we need to have a very good understanding what the county is going to say, what the traction looks like, and especially if we have a previous data point where we did a development, that is a home run for us. So example here, we're looking at a 5-acre tract, about $1 million an acre, that went under contract. We like that because on that road, we have developed 26 acres, developed almost 15 acres. Now they say the 5 acres. So we know that area. We have been there, done that 3 times. We finished one, completely leased. We finished the other one, it's already pre-sold. Take 3 came about, we are doing it. Versus we go somewhere else far away where we don't know, then we'll react about it as we go. Multifamily, our philosophy been everything, or multifamily is, it has to have a sign of distress or time pressure to sell. Distress is the wrong word, but the seller must have a time pressure to sell. Otherwise, we're not going to take a look at it. Enough is, it gotta be distressed. I mean, it just it got to be some sort of a price that we can go to. So that's a lot that I got today. So I'll take a little pause. Sanjay, if you want to add something to it, I know you're here. Then we can kind of go from there.
Yeah, no, this is a good, like what you mentioned kind of in an environment like this, you focus on the cash. If you have a cash flow, interest goes up, down, whatever happens, you have your coverage, right? So a lot of our deals that we underwrite, we look for that as a big component. So yeah, but there's a lot more waiting, and it's a balancing act, and a lot of the operators are trying to balance and trying to figure out a solution, but it yet to be seen where it all falls out. So
just to build up on that one, like if we have only one strategy, our bandwidth to make a play against the market or with the market to give us more time is very less. If we, just think about it. If we start like last year when we started, right, everybody would say, hey, buy in our backyard. So typically most of the people that we'll talk to will say, hey, I buy only value add more than 100 units in a certain location and has to be on a Monday, right? Then your likelihood of getting the deals is very tiny. And number one, if that particular strategy doesn't work, what happens? Am I not buying? So that you'll see a dominant part of the deal flow, or the folks who are trying to make deals that dropped. And the second layer, you'll see that, hey, Class C value add play was fantastic play, but for the next 3, 4, 5 years, that play is not going to be mainstream. There got to be something. And folks who understand that, they're ahead of the time. They make the play and go into the new development. And you'll see some of the senior players right now, they move to the new development play because of price and a 1 and 2, right here, 1 and that. And then for us, we was like, okay, we are looking at it as if the market changed, we are changing over time. But instead of being pushed around all the time, how can we integrate ourselves with another company or another team that we can build the expertise in-house? So when the multifamily doesn't work, we go buy land. When the land doesn't work, we go build triple net. When the triple net doesn't work, we go back to multifamily. When Houston doesn't work, we go Austin, right? So that's how we built the philosophy about our investment hypothesis, that we went to 6 markets simultaneously. We're buying assets across it so we can play with each other, play against each other from the local market. And also, you guys will see more. We are building very strong relationship at the company level with the new construction company out of Houston. And that gave us a lot of leverage in terms of the construction cost and the GC control, risk control, and operational know-how. All right. So I went rather quick, so I wanted to talk about it. It's a lot of questions I expect to come. And feel free to ask any questions you may have and how we kind of went about it, all this other good stuff. Tough questions as well. And then we'll go from there. Mike, I'm back at you, buddy. I'm gonna stop sharing so we can see each other and have a conversation.
No, it's good. I appreciate it, guys. And just one this is exciting just to hear the whole thought process around all this. And did want to announce, I put a quick link here in our chat for everyone. Come and sign up. We've got I'm calling it it's a M3 virtual reality, but real estate, because it's a really cool event of how we're going to do this. So sign up for it, August 11th to the 12th. I put the current link in here. We're going to have some more links to share later to show more about what's coming. We got some great speakers lined up for this, and it's going to be, an awesome event. Going to hear some stuff about AI as it relates to real estate. We're going to hear about the market from top lenders and debt brokers as well. So just jump in there and get in and sign up. It's free. And then there's an opportunity for a little upgrade to VIP to get access to more networking with top people, as well as copies of the recording. So. And are you back, Shrai? Are you taking a break? Huh?
No,
Okay. So
no, I was just saying, any questions anyone have, we can answer. And I had some of the questions from before. I can talk about those as well.
yeah, I haven't seen any questions in I'm checking here. I haven't seen any questions in the chat or in the Q&A.
We need to share virtual brownies and call and
Huh?
just the simple brownie, like a better word than office as well. Going to Denver, it has a different definition of brownie, so okay.
Go back to the oh, I see. Okay. Go can you go back to your slides real quick?
Absolutely. Right up.
On the yeah, no, going down. I mean, this is one link for the conference, but going down to the to your presentation slide. I just want to go back to that real quick. One more. Yeah, I like that one, but this, yeah. So so I was just take a look here, is, oh, sorry, I got to move my little boxes here. So I was thinking on a massive strategy, and some of that, is people are probably wondering, still, like, even though we talked through it here, why would you look into the offices in Houston, and I think we're going to have a session next week. It's going to be a little more on really diving in deep into why and how you would look at these. And even if you can buy, like, so distressed office, one of the things, even though, we can buy it, maybe even get it free, some people, but you can buy it really cheap, right? But it still may not be a great investment just because you can get it at a super cheap price, right? And so I know maybe Sanjay, you want to talk about some of that, and even though it's a way below the build price, it maybe still isn't, you know, where you want to be at this time. Just so I don't know if you or Sanjay want to leap in onto,
Yeah.
you know, even though you can buy something super cheap, you may not want to do it, you know, at this time
So
still.
let's use some hard data, right? So we have an office, I don't know, about 12,000 each or so square footage that we take. And we are, partnering with another company that the more information will come in, they use another 15,000 or so. So yeah, put together two, teams. We're looking, we right now we occupy 20 each thousand of square footage of footprint, right? And then we have our friends that we can call them in, they can come with us, they can occupy another 10 to 20,000, right? So roughly 20,000 to 40,000 of a square footage of space that we're looking for. That's a data point. That's something we have, not that many office buyers would have, right? That means when we buy a building right away, we can occupy up to 30, 40,000 square footage of space, right? So that's our play. On the flip side, we are actively looking for assets, 5-6 story buildings, 100 to 150,000 square footage of total spaces. And, we want empty or not empty, like a 50-60% of the space vacant, 10 and then 20-30%, so they're occupied, right? So we walked 3 buildings. I walked into first building, it's going to auction. There was one tenant was taking about 60,000 square foot of space. They moved out. Been there for 27 years. And they moved out, the building dropped to 30% occupancy. And seller is a fund, they bought it about a year and a half ago. Now, another thing that we understand, given the oil and gas changes that we had, it's a little bit more extra data that others don't have. About 3-4 years ago during the COVID, we did a lot of consolidation. That already decided that we're going to have a lot of hybrid opportunity. If you work for Exxon, Conoco, Phillips, Shell, hybrid is here. We're not going back 5 days a week. Those hybrid already kicked in Houston, so we're out of the market. And given the office of 2, 3, 5 years leases, we knew it's coming in. But this particular case, that engineering company got out. They could not keep them in. Occupancy dropped 30%, and then they have to go sell. Everything based on the NOI. So based on 30% NOI, best you can pay $20-$30 a square foot, whereas the land itself, it's $20 a square foot. So we walked the property, and seller said, if you can hit $40, the deal is yours. So a 1990s building, beautiful 1980s, mid-80s, 6-story building, beautiful building. Got a nice garage on West Hammer and close to Belto 8 for $40, $43 a square foot. That's the cheap offer. It is cheap for a reason, it doesn't cash flow. Now, when hypothetically, Billy from another syndicating team thinks that's cheap, I'm gonna go buy $40. Billy is right. But then the secondary question becomes, can you cash flow? At 30%, it doesn't cash flow. At a 60%, at 50%, you break even. At a 70%, you make the money, right? But how can Billy buy the asset, which is cheap, and they got the money, but what he has to do to lease up? That was our play. We can buy the same thing just because you walked in, we'll break even plus cash flow. And then our partner team has a brokerage arm. They are specializing, and they specialize on triple net assets. So when we show up, in-house leasing team with our friends, with ourselves, we could come in, pick up the occupants from 30% to about 60% just because we closed the building. All of a sudden, it made a lot of sense. So that's the play that we have, that we take a look at the distressed asset. We gotta have something different, and we kind of go on. You can win a deal is to make a deal happen. So we walk 2 more buildings the same way. $50 a square foot. It's there. Lending perspective, it is extremely tough. You say bank, they make a backflip. It's interesting how quickly tone changes when you say bank. And almost all the banks are full recourse now. Very less CMBS debt if you get it to up to 13%. And they want to see a cash flow. Some of the credit unions, local bank that we work, they underwrite at a 1.35 DSCR. That's a nice way of shut the deal down. So banks, that's the play. a lot has to go for someone to take a lot of risk to buy the asset. Thus, price has to be heavily discounted to offset. Good
And then
point.
yeah, great, thank you. And I saw there's a few other kind of along a similar line in the chat here. Going back a little bit was just kind of this all ties together. Just the view on industrial versus commercial multifamily, office retail. So I think that ties together with some of what we were talking about. And multifamily just versus, so basically all the assets versus each other, RV, storage, etc. So how do you look at that different opportunities, and from a return, an IRR, a current time, and how the rest of the economy is going right now in one asset class versus another, and so forth.
Those are some loaded questions. You can take at least 140-minute session on one of the questions about different asset classes, right? So I'll try to hit as much as I can.
So hit it high, because we're gonna hit it harder next week.
That's right. So in general, office world, where they're at. Just imagine Houston is ahead of the market about 3, 4, 5 years. Rest of the country is going to go through their fair share of it. So be very worried about when you do it, because they have a long-term step down conference. So that's office. Industrial, we have seen not much of a hit. That's because mostly, they are better than the office, smaller chunks. The industrial space, it's a business. Within the business, they have big manufacturing facility. Those tend to be much more shielded. And from the GP perspective, those are also a recourse loan. So it's a blend. Everybody's risk adverse there. So typically whoever bought an industrial space, they bought it at a decent rate cap. They bought it at a decent cash flow, less of a pro forma. Thus, they have more room to kind of weather through. And you see warehouses are going for the decent space. Retail, it's interesting. They're steady state firm. Smaller chunks, revenues there. People are shopping. We're doing it. Money's still there. And we believe the high inflation rate is there. It's going to stay for a little bit longer time. So it is still working now. So retail for us, we have seen now cap rate went down, but it didn't go down because retail never went out to rate cap rate 3, stayed around 5, 5.25 for Class A assets, and versus 7 or 8. So we're still seeing retail. It's a cash flow play, and it's doing pretty good. The multifamily, as you know, we believe the value add play has been shot pretty bad. So I buy the property, fix it up, hire, grow the rent, and then I go flip. That is not gonna be a dominant chunk, and it has to be on the development side of it. So we're bullish, and on the development side of it, not big ones. Something as a blend of retail and inner city retail and living at the same time. We expect to have a better plan. RV park, I think, is still there. I don't think it's going anywhere. Its cash flow is still flowing today, and yeah, that's our thing. So land, it's a big one. Anybody bought a land last couple of years, and the price must be reset. The price that we paid up until last year, it's different today. Land goes up the very tail end of the market cycle, goes up high because it gets squeezed out. When we can do a value add, we buy, new construction. When the new construction, good side goes away, squeeze the value out, kind of push the value out. And when the price turns, it drops the fastest. So that's a big one. Like we had a really good conversation with a really good team. It's tough to have this conversation. They have a really good deal in North Dallas, fantastic play, but they have a price that was stuck in last year. And that came up to be now. They needed to close in a couple of months, $30 million raise, and they have barely 2. And self-store is pretty good too, and they're steady state. Good questions, awesome questions. Okay.
I think
So go ahead.
No, go ahead, sure. Go ahead.
Okay. So for us, it's the risk-adjusted return. It's not quite this segment. and also flexibility, right? We want flexibility right now. We don't want one play to do. So for right now, we're doing land plays, we're doing a new construction retail, and we're sticking on with the multifamily, as we understand. So we want to buy in. Full idea about us is the market share. Buy as many as you can with a good base going in is that. And when we underwrite it, our philosophy always has been we're in for ones and twos. We're going to make our play every single time. Every time we get a chance to score one, we'll go knock it out. And what happens is we get into habit of ones and twos. All of a sudden, when the time comes, we'll make the home run, right? So for us, it's a risk-adjusted return. We are decently level-headed, and we try to adjust the risk as we go. And at the end, we look at the portfolio. We run everything is on a time. If all deals I do that sells in 5 years, then I'm stuck. I'm not going to do. Something happens, I cannot maneuver. So we kind of mix back it up. When we start the year, we said, hey, we'll allocate some amount of money for land, some amount of money for new construction, some amount from the existing asset class. From there, some amount for value add, some amount for class A, distributed by geographical location. So it's a portfolio to at the very back end. All right. Hopefully I'm not boring you guys with the long ways, and I think it's fun, and I think all the GP team, and one thing I would say, anytime you see a GP or syndicating team more than $50 million asset, you go dig and really dig hard. Make sure they understand portfolio theory, they understand the risk adjusted return, make sure they have a back office, make sure they really have understanding the macro view 3 years out, 5 years out, not the cookie cutter answer that we hear most of the time.
Yeah. I don't know if we addressed this when David had was around regards to the market. And another loaded question, either you or Sanjay might want to jump on, is what is the outlook for growth in the multifamily sector?
I'll let Sanjay go first.
The crystal ball. I'm not sure if Sanjay, so we got Sanjay there?
Let's see his head still.
Oh, sorry, I sat on the chair.
Yeah.
Yeah, so
Did you hear that? Okay.
yeah. My opinion, personal opinion, no financial, legal, tax advice here, is based on all the numbers, the way the data is, rents have to go up. We're not seeing that in the actual data in our actual operation. So lacking that, apartment values, the asset values, may go up a little bit or flat at an aggregate level. So when you look at United States, right, it's going to be either flat or slightly up, in my opinion. But there are going to be pockets, and then the volatility between different markets will be bigger. So the Carolinas, the Denver, the Texas, Arizona, those markets may see, a decent increase, whereas other markets that are not as, the growth is not there, may see the opposite. So the variability will be higher, but at an aggregate level, there is the asset pricing adjustment going to happen unless that rent does increase, which it should, but reality, we're not seeing that. So that's kind of my thoughts, my guidance is, I know it's not a very black and white, but that's where we are at. Fed changes their statement every month, right? So how can we not change it? So, but anyway, that's where I'm at.
So it's the same, right? And I have a similar belief. And Sanjay and I, we are macros, and if you ask me, so I'll take the same position. My personal, again, not attorney, not anything like that. It's my personal opinion that we believe on efficient market theory. We believe the U.S. market is pretty efficient. That means if the price goes up on one side, I have to bump up the price. And this is a capitalist society. So the owners will take a beating of the interest rate and increase tax and insurance. And once the market taught a little bit, settled down a little bit, we'll come back and push the rent off. It just has to be that way. And so I know instead of Texas, tax cut, all this other stuff, but guess what? I'm still paying a bill. And the moment we get a chance, we're going to go back and raise the rent. So yes, we believe markets can adjust, but not anytime soon. It's going to take 1 to 2 years of cycle for you to settle. And another thing is the syndication world, it's a lot more emotional world, because the most of the syndicators that we work, they're not a professional buyer seller, right? 1, 2, 3, 4, 5 deals, maybe. It's not institutional level. So if you take a look at REIT, price has been adjusted. But on the retail, it's not as lagging, right? So we believe that whatever turmoil that we have, we're going to go through for a year and a half, and then we'll see a bump in the rent. And it just has to be there. As long as we don't have to sell in the next 2 years, we're good. I have to have something special way up part to get to 2025 will be in a good spot.
Yeah.
And I wanted to share again, I think we shared in the chat a link, massive capital access. And it gives you just quick access to a lot of things, an introductory call with anyone on the team. If you want to do a deal with us, or you've got a deal you're looking at, you can go here and submit your deal. I've shared as well a link, but you can come here and sign into our investor portal. The link on the chat also, you can go. There's no charge, there's no expectation, no commitments to sign into an investor portal. It just lets you see what kind of deals there are on a regular basis. And then we got the coaching. If you're interested in our mentorship program that we have going on, we got 3 levels there, from, kind of a beginning all the way to, accelerator to, fully committed into being a full-time GP. And then a couple things on the bottom, a couple freebies, an IRA ebook, and a passive investor checklist. So check that out. I'll drop the link in there again for y'all. But yeah, just, jump into the portal or an introductory call as well, and get to know us a little better if you haven't. All right, get back to the chat.
Natasha has a question. Story built out. Okay, so let me make sure I understand it. Yes. So I want to go backwards. Is it 300? That's almost 400 units of RV and a boat, no climate control. That has a loan for 7.25%, and the loan is being levered to 82% of cost. And the question is, how do we feel about that? Short answer is we don't know. Long answer is we have to look at the assumption made in the play and assumption made in it. We have to check out the lease up business plan. We have to check out the been there, done that type and all this other stuff. Sanjay, go ahead.
Yeah. So, and I was going to add there, Natasha, one thing to, when you're assessing a deal or anybody, keep your operations and financing separate. So, you're looking at the loan to value, loan to cost, and that's the financing kind of start to play into it. First and foremost, look at the rents, look at the purchase price, look at your NOI, look at what is that NOI return if you bought it all cash, right? That's what your cap rate means, is if you bought with hard cash, NOI, the cap rate is the return on your cash that you use to purchase that after operations. Financing comes after that, and that's a big variable, right? Like right now, interest rate changes on an hourly, daily basis, and then you go by the asset type, multifamily, retail, office, RV park, land development. And in land development, you can go from one lender to the other, and like we're getting 60% to 100% LTCs on land development. And then the interest rate and terms are all over the place, right? So to answer that question, what do I think about that? It's really hard to answer with just that information, but of course, we need to catch up anyway. Give me a call. Are you back? I'm not sure if you're back in Houston yet. So let's catch up and let's talk about it. I'm happy to talk through the details of that. but keep operations and financing separate when you're thinking through the deals.
100%. And in this case, operations, financing, and construction. Okay, that's a new development. And then I want to twist a little bit. It has 3 phases. Every new construction has typically 3 phases. First phase, you buy the land, you go through the paperwork, then you exit. That section is to be profitable by itself. Second section is you buy the land at a title ready, then you go to the construction, lease up, then you sell. That should be profitable by itself. Then you come back in an operation, and that needs to be profitable as well. Sometime, when someone says, I'm going to buy land and I'm going to stabilize, then I'm going to sell, I will make the money. Question is, hypothetically, if you're making 20% after going through 3 phases, is it good? Versus I go through 2 phases and I make the same 20%. Risk adjusted return, right? It has a lot more to it. We have to kind of dissect it. A very good question. Sanjay, back to you, buddy. I'm giving you the homework to explain it.
Yeah. No, that's kind of the explanation there. So, yeah, I see people dropping off.
Excellent.
Thanks for joining. Who was able to join? More questions? We'd love to hang out here, as you all know. So,
We got the party after the party, right? The usual
Yeah.
stuff. It's about the time.
So that was good. I didn't know. Hey, so you met Natasha. So you, are you heading to Houston? Heading back to Houston?
Natasha, we're gonna make you speak.
Because you're in Alabama still or not?
I'm still in Alabama. I would have been back a long time ago, but I fell and it did a lot of damage, like a lot of damage. So I've just kind of been stuck here for a little while with like physical therapy and everything.
Oh,
And yeah, like falling after 21 is not really any fun. And I'm usually good for a tuck and roll, but I didn't tuck and roll this time. And I fractured like my tailbone, compressed my spine,
sorry to
knocked
hear
my
that. Yeah.
pelvis, and my leg around. So it's been a little complicated, but I've just been like, I'm going to push through and make sure I do everything virtually that I
Yeah.
can. So I'll be back in August for sure.
Okay.
All right. Well, best recoveries,
Yeah.
and glad to hear from you and look to connect. We kept trying to get over to Georgia and was hoping we'd meet in Atlanta someday, but we'll wait till Houston maybe now, and safe recoveries there.
Yeah.
Yes. Thank you. I was hoping to be able to go to Georgia too, because I was like, that's so close also.
Yeah.
But either one, we'll definitely meet at both.
100%. 100%.
Yeah. Good.
So, all right, guys. If anybody's got anything else, drop it in quick. Give us or just open your mic and ask your question.
Like, do you want to stop recording and then we go to the other section of it?
Yeah,
The
yeah.
official meeting ends.
Yeah,
The
can. I
unofficial
need
part
to-
of it. We should decide.